Hi, I'm Denise Anderson of Ibex Wealth Advisors, and I'd like to welcome you to our Economic and Market Roundup for 2024. Good morning to you all from our offices here in Bedminster, New Jersey on August 15th of 2024. Earlier this year, we produced a video that offered some general economic and market forecasts for 2024, which included a modest economic slowdown, but not a recession, the Federal Reserve holding interest rates higher for longer, a broadening of the stock market from the narrow leadership of stocks known as the Magnificent Seven, opportunities in fixed income markets, otherwise known as the bond market, and a resilient consumer through 2024. While underlying U.S. economic momentum remains solid in the first half of the year, a recent string of weak economic numbers has raised some important questions for investors, and I'll give you a hint. It all starts with the consumer.
With a slowing economy and economic data coming in weaker than expected, what is the most likely near-term scenario for the United States? Recession or just slower growth?
Consumer spending is the heartbeat of the U.S. economy, driving about 70% of its activity and playing a critical role in economic growth. Any analysis of the short-term outlook for the U.S. economy starts with the consumer. When consumers buy goods and services, it fuels business growth, sparks job creation, and keeps the economic engine running. This cycle thrives on a strong jobs market, which provides the income necessary for the consumer to keep spending, as well as low inflation, which preserves purchasing power, ultimately keeping more money in all of our pockets. Additionally, affordable interest rates make borrowing easier, encouraging consumers to finance major purchases. The U.S. economy's heavy reliance on consumer spending makes it a key indicator of overall economic health and stability, highlighting the importance of maintaining these supportive conditions to sustain momentum and resilience.
With a strong jobs market and inflation now significantly reduced, critical questions remain. When will the Federal Reserve act on interest rates? And is a soft landing still possible?
You may recall that a soft landing is that delicate balance where an economy slows down just enough to curb inflation, but avoids entering a recession.
The Federal Reserve, often called the Fed, is the central bank of the United States. It manages monetary policy primarily by adjusting interest rates, which influences borrowing costs across the economy, a crucial role in keeping the U.S. economy stable and functioning smoothly. In any economic cycle, managing monetary policy is a most delicate balancing act. If the Fed cuts rates too aggressively, it can overstimulate the economy, leading to high inflation and potential asset bubbles. Conversely, if the Fed doesn't act in a timely manner to adjust rates, it risks allowing inflation to rise unchecked or causing the economy to slow down too much, potentially leading to a recession. Our baseline scenario for the remainder of 2024 into 2025 calls for an economic slowdown, but it's pretty gradual. As such, striking the proper balance of cutting interest rates too much or too little is important. But with the recent string of weak economic data, the timing of potential rate cuts has become critical. You see, if the Fed holds off on cutting rates and then reacts suddenly to weaker than expected economic data, they might panic and reduce rates more aggressively than intended. Such a move could signal the Fed's fear of an impending recession, which ironically could trigger the very downturn they were trying to avoid. The Fed should be cutting rates because inflation has come down close to their 2% target. Not because they fear an impending recession. The message matters. One of the factors that makes such an aggressive path more likely is the unfortunate J-curve effect of monetary easing, where an initial negative effect is followed by a significant positive effect, resulting in a curve shaped like the letter J. The reality in the modern economy is that interest rate cuts likely slow the economy first before stimulating it later. Assume, for example, that you are earning 5% in a CD or a high-yield money market fund and the Fed cuts rates by 1%. You would now, hypothetically, only be earning 4% instead of 5% or 20% less, ultimately reducing your income and giving you less money to spend to support the economy. Recall, if you will, that consumer spending makes up 70% of our economy. Later on, of course, these effects fade, and both businesses and consumers will find relief from lower interest payments, which can help stimulate the economy. But if, in the short run, monetary easing actually slows economic growth, the risk of outright recession could rise, making it harder for the Fed to stick to its intention to ease slowly. Despite the short-term challenges posed by monetary easing, a slowdown in the economy seems more likely than a full-blown recession. So what does this mean for the markets going forward? For the fixed income markets, also known as the bond market, longer-term, high-quality bonds should benefit from a weaker outlook for both growth and inflation, especially if the Fed eases aggressively. Rate cuts also mean that those juicy 5% yields that we have been enjoying in CDs and money market funds will likely decrease. So locking in some of these rates by investing in higher quality with somewhat longer data maturities seems prudent at this juncture. Remember, longer-term funds should be invested in longer-term assets. A declining interest rate environment is also generally favorable for equities. A rotation from mega-cap growth stocks to small, mid-cap, and the other 493 stocks in the S&P 500 should continue, extending the overall broadening of the market that took hold in July. Also, if the Fed eases further, the dollar could weaken, making international markets more appealing. Finally, the mood on Wall Street can change on a dime, and the networks that cover the financial markets never miss an opportunity to instill fear into the viewers by playing incredibly intense music, filling the screen with glaring headlines of market panic in blood-red, bold letters, as the announcers' faces turn from happy-go-lucky to concerned and panicked, as the commentary quickly changes to the end of the world. Our best recommendation to you is to just turn off the noise, because most of it is really just that, noise. If you ever have a concern, please know that you are welcome to reach out to us at any time for a clear and rational discussion of what's really going on. We thank you for the opportunity to work together and sincerely appreciate the trust you have placed in our firm. Enjoy the rest of your summer, and we look forward to seeing you soon.